What if I told you the biggest threat to the US economy is not inflation, not AI, and not even China? It's something far more boring, something most people have never heard of. And yet this one thing may decide whether mortgage rates stay high, whether stocks keep getting shaken, and whether the entire global financial system stays stable. It starts in Japan, not with anime, not with sushi, with government bonds. For the past few decades, Japan has been one of the most important but least talked about forces in global finance. While most people were watching the Federal Reserve, Japan was quietly acting like the world's biggest source of cheap money. And that cheap money helped fuel everything from US Treasury purchases to real estate, tech stocks, and global risk-taking. But now, that era may be ending. And if Japan changes direction, the effects could ripple across every major market on Earth. So let me show you exactly why. To understand the story, we have to go back to the early 1990s. Japan's asset bubble burst. Real estate crashed, stocks collapsed, and the economy entered what became known as the lost decades. Growth slowed, inflation vanished, wages barely moved. So the Bank of Japan did what central banks usually do when they run out of options. They cut interest rates all the way down, then even lower, and eventually they pushed them so close to zero that borrowing money in yen became almost free. That sounds harmless, but in finance, almost free is where things get dangerous. Because when money's cheap enough, investors don't just keep it at home, they send it abroad. Here's the simple version. An investor borrows money in yen at very low rates, then they convert it into dollars. Then they buy something that pays more, like US bonds, stocks, or other assets. If the return is higher than the borrowing cost, they keep the difference. That strategy became known as the yen carry trade, and for years it helped power global markets. It wasn't just big hedge funds doing it either. Japanese banks, pension funds, insurers, and global investors all joined the hunt for yield. That created a massive flow of capital out of Japan and into the rest of the world. In other words, Japan wasn't just a country, it was a financial fuel tank. And here's the part most people miss. This only worked because one assumption held true. Japanese rates stayed near zero. The moment that changed, the whole system became vulnerable. In 2024, the Bank of Japan finally moved away from its ultra-loose policy. It ended yield curve control. Then it raised interest rates for the first time in years. And that mattered more than most people realized. Because when Japanese rates rise, two things happen immediately. First, borrowing in yen gets more expensive. Second, hedging currency risk gets more expensive too. That means the old carry trade becomes less attractive. And when the trade becomes less attractive, money starts to move differently. Some capital stops leaving Japan, some capital comes back home. That's called repatriation. And that shift can tighten global liquidity fast. Now you might be thinking, so what? Japan raises rates, why should that matter to US investors? Because Japan has been one of the biggest buyers of US assets for decades. That includes US Treasuries, mortgage-backed securities, and other long-term financial assets that help keep global borrowing costs anchored. When a major buyer steps back, bond markets notice. And when bond markets notice, everything else feels it. That's because the long end of the yield curve does not move only because of the Federal Reserve. The Fed influences short-term rates, but long-term yields are also shaped by supply, demand, and global capital flows. So if demand weakens, long-term yields can stay elevated even if the Fed cuts. And that matters because long-term yields affect everything from stock valuations to mortgage rates. This is where the story gets bigger. If long-term Treasury yields remain high, mortgage rates don't fall much. That keeps housing expensive. It slows refinancing, it reduces affordability, and it pressures homebuyers even if the Fed sounds dovish. At the same time, higher long-term rates make stocks harder to justify at rich valuations. Why? Because future profits are discounted at a higher rate. So even if company earnings look solid, the prices investors are willing to pay can drop. That's why markets can feel unstable even when the headlines seem calm. And it doesn't stop there. corporate borrowing gets more expensive, deal activity slows, private equity becomes less aggressive, credit tightens, liquidity shrinks, and suddenly the problem isn't just Japan, it's the entire cost of money. So the real question is not whether the Fed will cut rates. The real question is who buys the debt after Japan stops being the automatic buyer. That's the part that could reshape everything. For decades, the global system relied on one major assumption: Japanese cheap money would keep flowing outwards forever. But if that flow reverses, then global markets may have to adjust to a world where money is no longer as abundant as it used to be. That does not mean disaster is guaranteed, but it does mean the old playbook may not work the same way anymore. And if you're an investor, a homeowner, or just someone trying to understand why financial conditions still feel tight, this is one of the most important trends to watch. Because sometimes the biggest story in markets is not the one making the loudest noise, it's the one moving quietly underneath everything else. And right now, that story may be starting in Tokyo. So if you want more videos that explain the real forces behind markets, finance, and the hidden mechanics of global liquidity, make sure you subscribe, because the biggest risks are rarely the ones that trend first. They're the ones nobody notices until it's too late.